Commodities are physical goods that serve as inputs for production or consumption and are generally classified into energy products, metals, agricultural products, and livestock. Unlike stocks and bonds, commodities do not generate cash flows, making their valuation and return characteristics fundamentally different from traditional financial assets. Commodity investments are commonly accessed through futures contracts rather than direct ownership of physical goods. As an asset class, commodities offer potential diversification benefits because their returns often exhibit low correlation with equities and fixed-income securities. Understanding the sources of commodity returns is essential for evaluating their role in portfolio management and their effectiveness as inflation hedges. Commodity futures returns are commonly decomposed into three components: collateral return, roll return, and spot price return. Collateral return is earned on the cash collateral invested alongside futures positions and typically reflects short-term interest rates. Spot return arises from changes in the underlying commodity's market price over time. Roll return results from gains or losses associated with replacing expiring futures contracts with new contracts. Together, these components determine the total return earned by commodity futures investors. Understanding how each source contributes to overall performance helps analysts evaluate commodity investment strategies under different market and economic environments. Several theories explain the behavior of commodity returns. The theory of storage emphasizes the relationship between inventories, supply conditions, and futures prices. When inventories are low, commodities provide a convenience yield because physical ownership becomes valuable for meeting production needs. This situation can lead to backwardation, where futures prices are lower than spot prices. Conversely, high inventories often contribute to contango, where futures prices exceed spot prices. The hedging pressure hypothesis suggests that futures risk premiums arise because producers and consumers seek to transfer price risk to speculators, who require compensation for assuming that risk. These theories help explain commodity pricing dynamics. The shape of the futures curve plays a significant role in determining commodity investment returns. In backwardation, investors may earn positive roll returns because they sell higher-priced expiring contracts and purchase lower-priced longer-dated contracts. In contango, the opposite occurs, producing negative roll returns that reduce overall performance. Consequently, commodity returns depend not only on spot price movements but also on the structure of futures markets. Investors must therefore analyze inventory levels, supply and demand conditions, storage costs, and convenience yields when assessing commodity opportunities. These factors influence both pricing and expected returns across commodity sectors. Analyzing commodity returns requires distinguishing between price appreciation and returns generated through futures market mechanics. Historical performance often varies significantly across commodity sectors due to differences in production cycles, storage characteristics, weather conditions, geopolitical developments, and economic growth. Energy commodities may be influenced by global demand and political events, while agricultural commodities are more sensitive to seasonal and climatic factors. Effective commodity analysis, therefore, requires evaluating both macroeconomic conditions and commodity-specific fundamentals. Understanding the drivers of returns enables investors to assess risk exposures, identify opportunities, and incorporate commodities effectively into diversified investment portfolios. Commodity indexes provide a systematic method for measuring commodity market performance and serve as benchmarks for investment products. Index construction typically involves selecting eligible commodities, assigning weights, and establishing rules for contract rolling and rebalancing. Weighting methodologies may be based on production levels, liquidity, market value, or equal weighting schemes. The rolling process is particularly important because it determines how expiring futures contracts are replaced and directly affects roll returns. Different index construction approaches can lead to materially different performance outcomes. Therefore, analysts must understand index design choices when evaluating commodity investments, comparing benchmarks, and interpreting reported returns.